Hey team, it's Mikey Millions here, and in this video we're going to talk about what we should anticipate from a Biden administration's tax plan and financial policies. And right off the top, if you guys enjoy my videos, please do give this one a thumbs up. It really helps me out with the YouTube algorithm so that we can get this video in front of more people. As for the Biden administration tax plan, whether you like it or not, you have to admit that Joe Biden is going to be the 46th president, and as such, he's going to champion a tax bill. He'll likely get a lot of support from the very liberal House of Representatives, but the Senate is likely to stonewall since conservatives are going to remain in majority. Nonetheless, if Biden and Harris get what they want, the provisions I cover in this video are the ones that they're going to look to sign into law. Keep in mind it takes time to negotiate a tax bill, and any policies won't kick in until 2022. 2021's tax provisions will proceed as scheduled. Some of these provisions I'm looking forward to, and some of them rub me the wrong way, but we'll do a fair evaluation of both. We'll take these tax provisions one at a time, we'll talk about who's going to benefit from them, who's going to suffer, and how we as Theta Gang people can always come out on top. Provision number 1 is capital gains tax. I'm starting off with capital gains tax because we as Theta Gang traders are likely to realize gains every week, sometimes multiple times a week, so we will absolutely face capital gains tax. Under a Biden plan, anyone who earns over $1 million a year will lose the benefit of long-term capital gains tax. They will have to pay taxes on all of their capital gains as though they were short-term capital gains. That means that they are going to pay a 39.6% tax, which is the highest tax bracket under the Biden plan, regardless of how long they held their positions. They would normally, under the current tax law, be paying a 20% capital gains tax on long-term positions. Under a Biden administration tax plan, they will no longer have that benefit and they will pay 39.6% instead of 20% capital gains. There's no change to anybody who's earning less than $1 million in a year. I don't want to make the assumption that none of you are earning $1 million in a year, but if you are, be prepared that you're going to pay an additional capital gains tax, almost double what you're used to right now. A good move might be to sell covered calls in order to raise capital before you ditch a position, instead of selling the shares outright. That way the premium from that covered call can help you balance out some of that additional tax. You might also want to move some of your assets now into fixed income, rather than wait until 2022, when you might see your capital gains stuck behind an almost 40% paywall. If you make less than $1 million in a year, this change will not affect you, and you can still continue benefiting from long-term capital gains tax if you hold the position for more than a year. Provision number 2 is corporate tax. Under a Biden administration's tax plan, corporations will pay a 28% tax instead of the current 21%. That's a 33% increase in taxation, but well below the 35% they'd been paying for the last several decades up until 2017, and it's well below the highs of the 50s and 60s. Nonetheless, corporations have been getting used to paying a 21% tax, and once that goes up to 28%, they're certainly going to take a hit. Their bottom line will be affected, even if it's lower than what they've been paying even just 3 years ago. If that change passes, be prepared for a sell-off in equities as people ditch their positions in anticipation of companies' bottom lines taking a hit. But keep in mind, sell-offs like that tend to resolve themselves quickly, and people are still going to be picking up shares of quality companies on the way down. For those who do fundamental analysis, consider putting some weight into EBITDA as an indicator of financial strength. That's earnings before interest, taxes, depreciation, and amortization. Obviously, earnings before interest and taxes is not going to be affected by taxation. You can use this indicator as an assessment of financial strength because taxes aren't going to affect it. This might give you a better read of the company's growth as opposed to using earnings per share over the next couple of years as these companies adjust to the higher tax rates. Provision number 3 is payroll tax. Under the current law planned for 2021, you only pay Social Security tax on the first $142,800 of your income. After that, you'll only pay the Medicare tax, which is 2.9%, and you split that 50-50 with your employer if you have one. If you're self-employed, you pay the whole thing. For those who make more than $142,800 in a year, you get a break from Social Security tax, and you don't have to pay that tax again until the following year. That's the current plan. Under Biden's plan, any additional income you earn over $400,000 will be subject to Social Security tax once again. So if you make $500,000 in a year, you'll pay Social Security tax on the first $142,800 of income. You get a break between that point and $400,000, and then you'll pay Social Security tax once again between $400,000 and $500,000. Keep in mind this creates a donut hole in which you don't pay Social Security tax in between that $142,800 and the $500,000 mark. Anybody who's earning less than $400,000 will not see a change to their payroll taxes. The Biden campaign promises that this change will save Social Security by taxing only the highest earning individuals. I'll let you decide if that's fair and reasonable or if it's not. Provision number 4 is gun tax. Now here's a fun one. This one would likely be pushed separately from a tax bill as part of a firearms reform package. However, it is a tax nonetheless. The Biden administration plans to push for a $200 tax on all firearm sales payable by the seller. So if you were considering purchasing an M109 self-propelled howitzer for $20.1 million, have no fear, you will not have to pay a $200 tax on that transaction. However, if you were the seller of this weapon system, you would be liable to pay a $200 tax on it. For those who sell firearms regularly, be prepared to pay $200 taxes on the regular. I assume that this is going to force you to raise prices to cover the cost of that tax. If you buy firearms regularly, be prepared for your suppliers to increase the cost of their products by at least some amount in order to compensate for the additional tax. Bottom line, if you want to buy or sell a firearm, consider doing it now instead of waiting until 2022. That way, you won't have to worry about the additional taxes and the additional costs. Provision number 5 is the elimination of the step-up basis. This one really bugs me because I don't want to see the current law changed. Right now, under the current law, if you die, then the cost basis for any assets that you own adjusts to the price it was worth at your death. So for example, if you buy a stock for $100 and it goes up to $300 by the time you die, then your heirs will inherit the asset as though you had purchased it at $300. This protects them from taxes if they were to sell shortly after your death. Because of this, when your heirs inherit assets from you, they won't have to pay capital gains tax if they liquidate those assets shortly after you die. Under Biden's plan, this all goes away. Your heirs will inherit the same cost basis you had when you bought the shares. If they sell, they're going to have to pay capital gains tax on whatever asset appreciation took place between when you bought the asset and when you died. This change really does upset me because, frankly, I planned on dying with a large share portfolio so I could help out my heirs. If I were to die and they sell the assets, then they'd be able to sell without having to worry about capital gains tax. Under Biden's law, that advantage completely goes away. And keep in mind, it's not just for shares, too. I'm talking about houses, I'm talking about art, cars, collectibles, Pokemon cards, what have you. This applies to all of those assets. This is going to hurt people, but keep in mind that the tax law may change again by the time we die, and maybe we'll see the step-up basis come back. If you are worried about dying in the next couple of years, though, my recommendation to you is to take out a $100,000 term life insurance plan. It'll cost you something like $10 a month. And if you do die, then that $100,000 payout to your beneficiaries will more than likely compensate for all of the additional tax. Provision number 6 is the child tax credit. Now this is one that I'm really looking forward to, and I think it'll be so popular that even Mitch McConnell will get behind it, so we have a really good shot at passing this one. Tax credits should not be confused with tax deductions. In a deduction, you just take the deduction off of the amount of money you made that year and you pay taxes on the rest of your income. With a tax credit, you're actually dropping the amount of tax you owe that year dollar for dollar, which makes the whole thing much more powerful. So if you have a $6,000 tax bill from the IRS, but you have 3 children, then you can claim 3 of those tax credits for $6,000 total, and you owe the IRS no more money. Depending on how much money you make, some of that tax credit can even be refundable, which means that you can get money back from the IRS even if you paid no money that year. If you make above $400,000, this tax credit begins to phase out. That's the current law. Under a Biden plan, this tax credit will increase to $3,000 for kids over 6 years old and up to $3,600 for kids below 6. We're talking about an additional $1,000 plus off your tax bill each year. Obviously, this is going to be a big help to families, especially large families. There isn't much to say here since none of you are planning your childbirths around tax rates, but if you have kids, make sure you're claiming this tax credit. And when you do, consider using the money saved to fund a kid's 529 college savings plan. The money invested will grow tax deferred, and it'll be completely tax-free if you use it to fund qualifying education expenses. That'll be a huge help to your kids when it comes to making college affordable again. I've got a Patreon post on this topic if you're interested, and I'll link it in the pinned comment. Provision number 7 is the estate tax, aka the death tax. This is the tax that gets assessed when someone dies and passes on a large chunk of inheritance to their heirs. But if their heir is a spouse, then no tax is assessed. There's a lot of misinformation out there coming from $30,000 a year forklift operators who think that Biden is going to take half of their money when they pass it on to their kids. This is not accurate, and in fact, the reality is a lot less grim. Under current tax law championed by Donald Trump in 2017, in 2021, individuals who die can pass on their assets to their kids, and no tax will be assessed on the first $11.7 million. If the recently dead person was a widow who inherited assets from their dead spouse prior, then the amount of tax-free assets actually increases to over $23 million. In other words, if both of your parents die on separate dates, then you can inherit up to $23 million with no tax assessed. Biden's plan is to revert back to the pre-Trump rate and reduce this tax exemption from $11.7 million per person down to $5.49 million per person. Under current estate tax rules, you're going to pay anywhere between 18% and 40% on any additional assets above the threshold I just mentioned. Anyone currently inheriting $12 million from a single person, non-widow, would need to pay about 25% effective tax on that $300,000 above the exception, or $75,000 in tax. Under Biden's plan, that $11.7 million of exception would drop down to $5.49 million, so this person receiving $12 million of inheritance would need to pay tax on a much higher proportion of their inheritance. This will affect very few of us, but anyone who expected to receive $100 million of inheritance is going to miss out on some of it. If you do expect to pass on more than $5.79 million to your heirs if you're single, or more than $11.58 million if you're married, consider getting yourself a survivorship life insurance policy. The payout from the survivorship life insurance policy will help cover the cost of those taxes without having to dig into the value of the assets themselves. Provision number 8 is first-time home buyer credits. Houses are becoming very expensive, and for better or worse, we can't count on another 2008 market crash so that we can buy our first homes on the cheap. Biden's tax plan would help us out a bit by awarding a $15,000 tax credit to first-time home buyers, which is receivable at the time you purchase the home. This is a revival of an expired Obama-era policy from 2009 that awarded $8,000 to first-time home buyers. Biden's plan would almost double that. Needless to say, this is going to help out first-time home buyers immensely, and I think it's going to be such a popular provision that it'll pass the Senate even if conservatives stay in majority. If you do get to take advantage of this, my recommendation is to not buy a house that's just a little bit outside your budget because you plan on getting a $15,000 tax credit. Instead, I recommend getting a house within your budget and then using that $15,000 tax credit to improve your house itself. Take that $15,000 and upgrade your kitchen and bathrooms. You're probably going to get a lot more out of those improved rooms than you would have if you took that $15,000 and bought a house that's just outside of your budget. Also, improving those rooms will increase the value of your home right off the bat, perhaps even past the $15,000 you spent on it. So if you do turn around and sell, you're likely to get some equity right there. This leads us into our next provision, just a couple more here. Provision number 9 is 1031 like-kind exchanges on real estate. Most of you probably haven't even heard of this provision before, but some of you are going to be very upset. Under the current 1031 law, if you sell a property that you used for business purposes, like rental property as a landlord or an office, and then you roll the money from that sale into a new property used for business purposes, then you don't have to pay tax on that initial sale. You sell your old property, roll the money from that one into a new property over and over again as many times as you want to, and you don't have to pay any tax until you ultimately sell your last property and do not buy a new one. Under Biden's plan, this provision goes away for anybody who's making more than $400,000 a year. So if you're a successful house flipper who buys property, fixes it up, sells it, and then rolls the money into a new house to repeat the process again and again, then you are likely to have to pay an additional tax on this. I'm not sure why this provision is even necessary, and it just feels like a kick in the teeth to the people that make their living by fixing up properties and selling them, but at the very least it only affects people that are making more than $400,000 a year, so that won't be most of us. But some of you are likely to take this hit. And last one, provision number 10, this is changes to traditional 401ks and IRAs. Again, this one has been subject to a lot of misinformation by people who think that they're going to lose the tax advantages on their retirement accounts. Fortunately, the situation is not nearly as dark as the people on Parlay and Twitter are saying. We all know the basic premise of a traditional versus a Roth plan. In a traditional, You don't pay any taxes now on your deposits, but when you go to withdraw, you have to pay tax based on whatever tax bracket you're in at that time. In a Roth, you do pay taxes now based on your current tax bracket, but when you go to withdraw, you don't have to pay any tax. For those in a high tax bracket now, it makes sense to use a traditional plan because you'll avoid paying tax on up to 39.6% of your income. And then when you go to withdraw later, presumably you'll be in a lower tax bracket, so you just pay that lower tax rate. But if you're in a low tax bracket, then it doesn't make much sense to use a traditional plan because you're maybe avoiding only a 10% tax, and then when you go to withdraw, you're going to end up paying tax with the same rate, or maybe even a little bit higher because you really can't get much lower than 10% tax. The Biden campaign said this is unfair because it's too advantageous for rich people and it doesn't do enough to incentivize the poorer people to invest, since traditional plans are just not that useful to people in lower tax brackets. So in Biden's plan, we're getting rid of tax deferrals when you deposit into a traditional IRA or 401k. All that is going away. Instead, what we're going to do is give a 26% tax credit on whatever value you invest into a traditional plan. Do the math, and you'll find that people in the 24% tax bracket or below would do better under the new system. People in those tax brackets would actually get more value out of a 26% tax credit than they would save under the current deferral system. On the other hand, people in the 32% tax brackets and higher are going to take a loss due to this change. Those people would have been better off deferring their taxes than they'll get back in value from the 26% tax credit. This will drive the higher earners into Roths, and it'll drive the lower income earners into traditional accounts, which is the opposite of what we have today. And if you're in a very low tax bracket, this will actually help you out tremendously, as you'd always be better off under the new system than you would have in the old system. Higher income earners will lose almost half of the benefits of using a traditional plan, and unfortunately, Roth income limits for 401ks cap out at about $139,000 for single individuals. After that, people can only use Roths if they use what is called a Roth conversion ladder, which is a loophole that may also go away at some point. In summary, this change is going to hurt the upper class, it'll help out the middle class a little bit, and it'll really help out the lower class. Do some self-actualization, realize where you are on that hierarchy, and invest accordingly. For me personally, I'm going to see where my income is in 2021, and if I'm in the 24% tax bracket or lower, I'm going to switch my current Roth plans to traditionals. Hey, I know that might not have been the most enjoyable video, but I want to thank you guys for sticking it out with me. Let me know what you think of the tax plan in the comments, and let me know if there's other topics that you'd like me to cover. I appreciate everybody watching, be sure to like and subscribe, and I'll catch you next time.